I'm Glenn Freeman from Morningstar, and I'm here to talk to Peter Warnes to get the highlights of his 2018-19 forecast report. Peter, thanks for your time today.
Always good to be here, Glenn.
We just kick it off. We're talking about you've got some pretty interesting comments about the economic cycle, and you're saying how it's not normal the way that things have unfolded since GFC and where we are now with regards to fiscal policy, monetary policy. What's happening here?
Yeah, Glenn, what I've been saying for quite a while now, since kind of September last year, that one of the clouds on the horizon for financial markets globally has been the potential clash on a major scale of fiscal and monetary policy in the US. This has come about because the Fed has been purchasing assets since the GFC, has a balance sheet now of over $4 trillion, and it has to be normalised. Interest rates have to be normalised, and fiscal policy should be going hand in glove with that. Now, in a normal economic cycle, you have fiscal and monetary policy working together. So the normal cycle is you have start off with low interest rates, and that encourages activity. And as those low interest rates and the government on the fiscal side running deficits, in other words, supporting the low interest rates with increased government expenditure, then you get demand driving the economy, and ultimately you get a boom. Now, as you get close to that boom, what happens is that capacity utilisation is under pressure, prices go up, inflation starts to emerge, and then the central bank has to say, hang on a second, this is going too fast, too quickly, we'll start quietening it down. So what do? They put interest rates up, and at that time, that's monetary policy, the government starts running surpluses, in other words, withdrawing or lowering government expenditure, and so that quietens the economy down, and then you have the peaking, and then down we go again, and to the trough, and then up we go again. So expansionary and contraction over an extended period, about over a decade. We have the decade cycle. But we haven't had that now since the GFC. So the GFC was 2008, we're 2018. We haven't had any interruption in a normal sense of the two policies working. So now, in the US in particular, we have the Fed, which started increasing interest rates in December 2015. They've increased the rate 7 times. They are starting to normalise their balance sheet, selling assets that they had repurchased to get the economy moving post-GFC, and that should push interest rates up because the economy is starting to move. The inflation starting to look a little bit more elevated, and they want to normalise again monetary policy and their balance sheet. In comes Donald Trump and says, tax cuts, unfunded, $1 trillion worth of infrastructure spending, and so the US Treasury has to go out in the market and fund that by issuing bonds. So that means that he's clashing. That's a clash between monetary and fiscal policy.
Has this happened in the past, this sort of clash?
Well, it may have happened, but not to the extent it's happened, because, again, the problems that GFC presented to us, we've never seen that either. So you've got a major clash there. Now, normally, in that normal situation, that wouldn't happen. But now you've got it. Now, so interest rates have to go up, and the Feds push them up. But the bond market, which is many, many times bigger than the equity markets, is saying, well, hang on a second, we're standing off here. We're not accepting what's happening, because bond yields move when inflation was on the run, and economic growth, which supports inflation, if you like, or drives some inflation, is on the run as well. Now, when the Fed moved first in December 2015, the 30-year bond was 3%. it's 2.95 today, after 7 increases in official rates in the US.
Still at that level.
The 2-year 30-year spread, or the 2-year 10-year spread, is down from 70 basis points in February to 28 today. So the bond market is saying, we either don't believe inflation is a problem, or we don't believe that the economic growth is sustainable. So even in that whole scenario, the central bank has blown up a balloon, if you like, and it's just about at bursting point. They've got to start taking the air out. In other words, that all that liquidity that's gone into that balloon, that's a dangerous exercise at the best of times. But now you've got this other situation where fiscal policy is against it. The chances of something coming unstuck there are relatively high. And then if that happens, then interest rates and bond yields are going to go north very, very quickly.
Could this also flow onto other markets? So is Europe potentially exposed to something similar happening, or have they got some quite fundamental differences in?
Well, they haven't got the same problem as the US because they haven't got someone sitting there with, throwing money and stimulating the economy. They've got the same problem, the ECB got the same problem as the Fed has got. They are almost they'll cease asset buying at the end of this year, and then they'll start, rationalising or normalising their balance sheet. But they're way behind what the Fed's doing, and so no, the Fed is leading, and the problems in terms of bond yields will happen in the US. Yes, other markets will follow, but the US will be the leader there. And of course, don't forget those bond yields. The 10-year one in particular, that is your benchmark risk-free rate of return, off which discount rates are used to value equities and capitalisation rates are used to value property. So the risk assets, which basically are interest rate driven, if you like, are going to be under pressure.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.